To be in your house and to gather in your name in the name of Jesus. We thank you for the opportunity to discover our finances and find out how they work for us and how we can best use them to grow our finances so that we could be a blessing not only to ourselves but to others. Lord, we ask that you multiply and increase our income so that we can do some stuff. We just ask that you open our minds to receive the knowledge and the wisdom that you're going to give us today. We ask that you let us be open to receive what it is that we need to learn on today in order to do better and be better and to create financial literacy. In Jesus' name we pray. Amen. All right. So I know on Sunday they asked me to back some things up. Some people wanted to kind of go back to the beginning. I don't think I'm going to go all the way there, but I'm going to touch on some things. But before we do that, Michael, I know you had some questions, so you want to start with your questions? I know, and Michael's had a rough day, so he might not remember everything he wanted to ask me.
Okay, then this is a good thing since I don't. What happened today? I lost my wallet, and people's been charging stuff on that account, but it's, okay, so I can even get there. Okay, now when I invest in stock, just say hypothetical, like today, when I lost my wallet and everything else, then I know what Stash give you, like a debit card, don't?
Yes.
Debit card. Let's just say hypothetical, if somebody say
found your
found
Stash
that,
card.
And then they went into the stores and they used that, then I would do the same thing like I'm doing now.
Stash is a little different in that it will not let you charge if there's no money in there.
Okay.
So you know how our banks will let us overcharge so they can charge us a $36 fee? Stash won't allow that. If all you have is $10, that's all you can spend is $10, and it does not affect your stock side.
Okay, now suppose I had more, just say hypothetical, I had $1,000 in that, but then you're saying the money that I invest in the stock,
yes,
they couldn't touch that.
They can't touch that. If it's not sitting, because you can add cash to your stash account on both sides. You can add it to the bank side and you can add it to the investment side. Okay. If it's on the investment side, it cannot be touched by your stash card at all. Okay,
so then, so that's a good question then. Okay, so the investment side, like I would have like a PIN number, something to
that's on your bank side.
Bank side.
That's
so
on
now,
the bank side.
Okay, now so the investing side,
the investing side that's money. Basically, is just holding that money until you invest it. You can't use it for anything except to invest because it's on that investment side. Any money that you have on your stash card side, then that's money that you can spend using your stash card.
Okay, so the money I got in the investment side, nobody can
touch that. No, it's not attached to your card or your bank or anything.
So the only person could
touch that is you, and that's if you log into the app.
Okay, so it's logging like security for only me to be able to really.
Only you can access that side. Yes.
Okay.
But like I said, the stash card is just like any other debit card. It's linked to a bank, but Stash will not allow you to swipe for more than is in your account. So say like if you have $500 on your investment side and only $5 on your bank side, you can't spend $10 and pull it from over here from this $500. All you have is $5 to access with that card. Period. Nothing else.
Okay. Yeah. Okay, yeah. I'm going to think about them other questions I had.
Okay, I know you kind of off today. That's fine. All right. So some things we're just going to go back over. Is the screen capture started? Oh, we can turn it on. Hold on, I haven't turned it on yet. Just to cover some very basic stuff, what we're talking about, there's multiple types of investments. Right now we're talking about investing in the stock market, whether you're investing in stocks or bonds, you're investing in the stock market versus real estate investments and everything else, futures and hedge funds and all of that kind of stuff. I am strictly real estate and stock, so I can't help you with the rest of it until I figure it out. So you understand, when you're investing in stock, you're actually buying a piece of the company. You're holding, you actually have equity in that stock. And one of the things I think we didn't cover, most of what we buy is common stock, not to be confused with common block down the street and around the corner. All right, so this entitles you to you got me, AJ?
Not yet, it canceled out for some reason.
Okay, let me see.
Okay, so I'm seeing you now, okay.
You see what I'm talking about with the different sides of where your money is in your stash account?
Yeah, well, no, I'm talking about got you live.
Oh, okay.
I kind of, my mind's kind of wondering, but I understand, guess you got me here too.
Mm-hmm.
I understand because they're two completely separate deals. It's just like with the bank, so in other words, that when I invest in this stock, nobody can, that's a safeguard. The only person can really touch that is me, so,
Yeah. Okay, so like I said, stocks actually come in various classes. You have A class, and I forget what the other classes are. But like I said, the one you're most concerned with is common stock. Unless you're a baller, I'm not. Unless you're a baller, then most of the times when you invest, you're investing in common stock. And according to this definition, shares entitling their holder to dividends that vary in amount and may even be missed, depending on the fortunes of the company. So, like I said, you're a retail investor versus an industry investor. Those are the companies that invest. But you as a person are a retail investor. And you normally only have access to common stocks. Unless you have some type of in with a brokerage firm, you're usually are only going to have access to common stock. So I just wanted to make that clear. And then the other thing is, like I said, when you're investing in stock, you're buying a piece of the company. So you actually own a small piece. You could be a part of like when they have votes and different things about the company, but your fractions may be so small that your vote does not matter, because for every share you own, you get a vote. But you got to figure your 13 or 20 or whatever shares versus their thousands of shares. Because when we looked at it before, when we talked about volume, how there are 3 billion or 3 million shares out there, so everybody that owns a share gets a vote. And normally that's why people try to have a controlling interest, so that they can control the vote and they get to say what goes on with certain companies. When you even though you have small amounts of shares, you're still entitled to a vote. So sometimes you may get things in the mail that say proxy vote. A proxy vote is when you're giving someone else permission to vote on your behalf, and they can do that. So if you have a company that has an outstanding stock portfolio of 500 shares total, that's all they have existing in the world. So they have 500. And so this person over here has 100, this one got 25, she got 2, and whatever. This one over here with 100 may send out proxy votes, or proxy votes may go out, and they'll ask, who are you going to allow to vote for you? Is it going to be the person with 100, the person with 2, the person with 25? You may not know the names on the list of people who are allowed to vote for you, but you're giving those people the right to vote for you. That's what that is. So when you give them the proxy vote, so say like if you took your 5 and you gave it to the person that has 100, so he can cast 105 votes on however he feels. She can still only vote 2, and he can still only vote 25, unless they also got someone else's permission to vote. So when you get those things in the mail, that's what a proxy vote is. You're giving someone permission to vote on your behalf, and usually, if you don't know, it's the person that has controlling interest, okay? I want to introduce you guys to Investopedia. I'm trying to find, what am I looking for? On here, there are a lot of definitions. that you can have access to. Hold on. I hate when this comes up. Okay, so like I said, everything is that you ever want to know, not everything, but a lot of the definitions that you may not be familiar with are on here. Some people have 401ks, 403bs, 457 plans. That's all through people who have jobs. 529 plans, those are usually for your kids when you're trying to invest for them to start college. So that's what that's for. I wanted to find something specific on here. And let's see. Give me a second. There's a lot, huh? And all of these are investment terms. So if you ever have time and you want to increase your investment knowledge, definitely go here. Definitely go here and look these up. But when we're talking about market share, like I said, market share is when you actually own a piece of the company. When you're investing in bonds, you're actually loaning them money. There's a difference. So either way, bonds are not as favorable as stock, but they're more consistent in how they ride out the market. And with bonds, you typically always get a dividend, whereas stocks, you don't always get a dividend. The only reason to invest in bonds is because you're trying to generate income. And for further clarification, the only reason you invest in the stock market is that's to make the money work for you instead of you working for your money. That's the bottom line for investing. You want your money to be out there. Somebody once said you want your dollars out there making dollar babies. Someone told me that once. So if you got $1 out there, you want it to go out and make 10 cents versus you having to go out and make 10 cents by working. Okay? So like I said, when you own a market share, it's the percent of a total sale in the industry generated by a particular company. So when we talked about that company just having 5 shares, you own a percentage of that whenever you buy a share of stock. Okay? And to give you further clarification, it says market share is calculated by taking the company's sale over and see, this is all math stuff. This is why I keep saying I'm gonna make slides for you guys so you can see the math. Just know that whenever you buy stock, you're buying little pieces of that company. And this is why, like I say, I harp on doing it for your kids, because if you start now, even if you're starting off with 10 shares now and it's paying dividends and you're reinvesting those dividends, then that could give the next generation maybe 100 shares because you just let it sit there and consistently do its thing. But the ultimate thing that you want to do, especially if you're looking to retire off of this, the reason you want to generate dividend income is because that's another stream of income. A lot of people, as they age and they retire, they just pull their money out. It's like they just start depleting their 401ks and all of that kind of stuff, so it's no longer working. And so you look at it as a standpoint, like say you have $500,000 in your 401k. The longer you live, the less you have, because they're letting you deplete that. Every time they send you a check, every month, you're depleting your 401k. Whereas if you had invested in something else outside of 401k, it would still be making money. Now, that's not to say that there aren't certain stocks in your portfolio of your 401k that aren't making money, but most people just continuously deplete it. So it's like you build it up to spend it all. And you talk about leaving a legacy, sweetie, that's not leaving a legacy. That's you spending everything that you worked for. That's it. So unless you know how to work the 401k and how you want your tax liabilities to look once you retire, then that's what you need to look at. All right? So, like I said, when you're talking about market shares, that's what you're talking about. When you're talking about bonds, like I said, bonds are all about loaning the company money. Let me see this bond on here, right here. Oh, crap, went too far. A bond is a fixed income instrument. So see, it's creating income. And even though it's not as much, you may not get as big a dividend as you would on a stock. It's still better than a savings account. Way better than a savings account. So it's a fixed income instrument that represents a loan made by an investor to a borrower, typically corporate or government. It can be thought of as an IOU they have on here. But just know when you're investing in bonds, having that diversification of stocks and bonds makes it a little safer. If you're basing it on your risk aversion, then you probably want to have more bonds than stocks. You want stocks because you want a little better growth, whereas you want bonds for more consistent income. So, go ahead.
Now, when you buy bonds, don't you buy bonds like, say, like for a year, or like, don't bonds have like a
Maturity date? That's when you just drop buying straight bonds. U.S. government bonds, like where you get the certificate and all of that kind of stuff.
Okay, now
These bonds are totally different. When you're investing in bonds, you're investing in mostly, they're in funds, and I think we covered funds, and I'll go back and see if they have a definition for that. But when you're investing in bonds, you're actually investing in the company, whereas most bonds that you get where you get the certificate, those are government bonds. And so people used to buy those, like you get a $50 one and you save it for your kid for when they go off to college, so they, instead of 50, they probably have 100. That's about as much as they're gonna get from it. But that is a 50% increase. But it just depends on that whole aspect of it. But normally when you're investing in bonds based on a company, it's not the same thing. You're not gonna get anything, there's no maturity date. And it just doesn't operate the same way as the government, let me put it like that. And normally if you're investing in a bond fund where there's a group of companies where you're loaning money to, they're probably switching them out anyway, so there's never really a maturity date there. That's what I was trying to get to. So investing in bonds versus investing in a bond fund is probably never going to retire. They're just trading out whatever bond or company bonds they're investing in. That makes sense? Yeah. All right. So, AJ, you sitting over there now, and you got any questions? Why do I keep hitting this? Here is, that's why. There was one other thing, and I
was just thinking, bonds seem to be what you would use if your stocks do little dips. That way you can rely on your bonds while it's dipping and then eventually going back up.
And that's why you have diversification. So you understand diversification is across industries and it's across platforms. So you want to have a really good diversification, you want to have, say, U.S. stock, you want to have international stock, and you can run the gamut of having one from every nation, or you can pick which international stocks you want to do. Like if you just want to invest in Asia or the UK or whatever, you can actually buy international stocks based on that. But you want to have that diversification. When you're investing in bonds, you want to have a diversification of long-term versus short-term and different things. So if you have all these different things going on, you're creating that diversification so that when these may drop down, like if these stocks over here are on NASDAQ, but these are on the Dow is having a good day, the NASDAQ is kind of sucky, so it kind of levels out. And if everything is doing well, then it all comes together. So I think I told you guys, when Morgan started her investment fund, when she started her investment account, she had Nike, EA, Starbucks, and Microsoft. And she was doing really well on most of them, but EA was dragging her portfolio down. It was always in the negative. It wasn't doing anything. So it normally looked like her average return on her portfolio was about, I think, about 10%. When she dropped EA, it doubled because that average was no longer being dragged down by EA. So you have to look at it from that diversification. When you're, is that somebody? Oh, okay. So when you're trying to diversify, you have to figure out what works best for you. Most people will think that the younger you are, the more aggressive you can be. That's fine, but you need to, if you're going to be aggressive, you have to make sure you take calculated risk. If you're constantly trying to invest in IPOs, which are initial public offerings, I would probably never do that. And IPOs, like I said, initial public offerings, those are when the company first come onto the stock market. They first show up on the scene. So let me see who showed up recently. Huh? Roblox showed up? See, I don't even care. Even though my daughter likes to play. When did they show up?
Less than a week ago, I think. I got a little stash thing bonus for them. Hey, IPO, you want some Roblox?
Really? Because I know you sent me the thing for the Bumble. Was that the same thing?
I think so. Something like that, yeah.
Oh, wow. Okay, so Roblox. Roblox is an IPO. It's actually a game that kids play and so forth. And so they've only been on the market for a week. I don't see Roblox going anywhere because kids have been playing it for a while. So if you're going to take a risk on an IPO, I would take it on something like that because I know how much my daughter plays and how much other kids play. How much is it selling for, AJ? Do you know?
At the moment,
What's the ticker?
it is RVLX.
If I tell my daughter this, she's going to want to buy some.
Last price was $77.06.
Wow. Okay. It doesn't have... So it looks like they opened at $60.50, and their high point has been $78 so far. If your kid plays Roblox, and you know they're going to keep playing Roblox, and they work your nerves about Roblox, you might want to invest in some Roblox for your kids. This stock right here would be a growth stock. This is what you invest in for a growth stock because there's no dividend on it. It's not paying anything, so you're just waiting for it to go up. And Michael said, I left off the most common thing, that you buy low and sell high. All right, so if you're going to buy this and you say, okay, once it hits $100 a share, you're selling, that would be what you do. That's the only way you're going to make your money off of growth stocks. You're not going to make it in dividends or income, so you're going to make it in buy low, sell high type of volume. They only have, 20, the volume is 29 million. Their average volume is 58. Wow, okay. Their 1 year target is 72. They already passed that because it looks like even today they're at 76.32. But like I said, if you know that your kids are into these games and all of that, let's see. I just want to see. Yeah, it did just go out. Looks like March 10th. Yeah, because the inception date isn't on here.
The promotional credit I got was for the 11th. So
Okay.
probably around there.
Oh, and something else I found out. Once you hit a certain level on Stash, I don't know if you guys have it turned on. There's a thing on Stash where it's called, I can't think of what it's called now. But basically, you're loaning them money to invest. And I had done it a while ago, but I guess I never had enough money before for them to loan out. They just finally sent me my little piece of something. I said, okay. So at least I know now I have enough for them to loan out, and that's another way that you make your money. Let's see, what were we talked about bonds, we talked about stocks. Like, AJ, next time, send me a text so I make sure I do some math stuff. Because like I said, I want to tell you guys about debt to equity ratio and the different ratios and all of that kind of stuff. It's kind of complicated without showing you the math, and so I want to be able to show you the math. But that's kind of the thing. Let's see, what else do you guys need to know on the basic? There are numerous platforms for you to invest with. Like I said, I use Stash and Fidelity. Neil uses Stash and Fidelity. My daughter uses E-Trade. And then I know someone who just recently used Webull. There's also Acorn. And someone was asking me, and I keep seeing the the ad for it. I might try it out. Have you heard of Coinbase? Coinbase, I know someone here keeps asking me about cryptocurrency. And so Coinbase, from what I understand, Coinbase is one where you buy and sell, but it doesn't, let's see. I'll have to look into it more, but supposedly it's really simple. It just, like whenever you buy something, it takes the extra, you know how they kind of, what is it? When they ask, do you want to invest donate your change? You know, do you want to round up $1 and invest your change? Yeah. So to my understanding, Coinbase kind of does that, and it invests in cryptocurrency. So I will look more into this, because I know, like I said, I know some, ooh, that's nice. I know some of you are interested in cryptocurrency. Like I said, I think this one might be an easy one to do if you want to do it on your own. I don't think it will take a lot, but I will try and look into it more to find out. But because cryptocurrency is a really big deal, people are trading Bitcoin. Like even when a lot of people that I've found out that use various cash apps, they can take that cash app and turn it into cryptocurrency. So, and I think cryptocurrency is growing faster than some of the other things that are out there, the traditional type of investments. Okay? All right, let's see some, I forgot what else she asked me to cover, because like I said, she wanted some basic stuff. La. You don't want to hear me do that, huh? I want to make sure that I cover all the stuff that she kind of wanted to know about. All right, let's just pick a stock. Let's see how, this is the one I know, SCHD. This is one I know people have invested in here. This is a dividend, nope, that's not it. SCHD, there it is. And it's still giving me the wrong one. What the heck am I doing? Right there. There we go. Okay, so this one kind of had a sucky day, but I like this one. All right, so the previous close was 72.63. It opened at 72.58. Okay, so what that means is that when the day started, when the trade day started, this is what they started selling it for. But there's a difference in the ask and bid. But when the stock market opened, if you're going to buy anything, you're buying it based on market price. So if this is there, and the thing about it is that price can change within seconds. So what you may put it in for, depending on what platform you use, and see some platforms are even slow, because Stash, you'll tell them to buy you at 8 o'clock in the morning, and they won't buy it for you till in the afternoon. So, huh?
I think I researched it, and they only have like 2 trading windows or something.
Okay, so AJ is sharing with me that they only have 2 trading windows, and that means that they can only buy 2 different times during the day. So, like I said, if you put it in at 8 o'clock in the morning, they might not buy it until 12 in the afternoon, and the price that you saw that morning might not be the price that you got it for in the afternoon.
So basically, let's just say, for instance, AJ bought it, say, Friday, then I turn around and bought it Saturday. That make you even buy it cheaper, right? Higher.
Cheaper or higher, but see, there's no trading on Saturday, so it's not going to kick in until Monday. Yes, and see, some of them will let you put it in that you want to buy, but it's not going to process until Monday, till the bell opens on Monday. When you do stuff like that, okay, let me take Fidelity for instance. Fidelity, certain ones, if you want to, okay, let me back up because I'm skipping all over the place. If you want to buy stock on Saturday and you want to buy it at the price that you saw that AJ got it for, so say you know that stock is still fluctuating. So AJ was able to get it at $75 a share. But when the market closed, it was at $76 a share. So there's that dollar difference. But you know, like you're expecting it to go back down for a minute before it goes back up. So when you invest, you can set it for a limit. So you can put it in there. It's like, okay, I want you to buy me 5 shares at $75. If it does not drop to $75, don't buy it. That's you putting a limit on what you want to spend and what you want to buy that stock for. Does that make sense? Okay. And you can do the same thing with selling. You want to, if it gets to this point, like, because you know this stock is dropping, if it gets to this point, you saying, okay, if I bought this at $80, if it drops down to $78, I want to sell. So you can put a limit in there that says, okay, if this hits $78, sell all my shares. And then that way you can control how much you gain or loss or whatever, okay? So that's what you do when you put in limits. Something else on here, just so you know, the days range, the stock fluctuated between 71.80 and 72.60 over the last year, 52-week range. If you were in a year ago at $38.83, you will have doubled your money because it's at 72.20 or 72.70. That's kind of nice, isn't it? So
the whole end of March area.
Yeah, that whole end of March. If we knew then what we know now, if everybody had went out and just put all their money in the stock market when everything was dropping in March, we would all be a whole lot richer right now. But that's okay. You live and you learn. So that's why usually when the market is dropping, you should continue to buy because you're trying to get it at the lower price. Because you know what it peaked at and how long it was there, and the market always continues to rise. So you want it, when it does drop, don't panic, buy more if you know it's a solid stock or a solid bond, okay? So say Microsoft is up to, let's see what Microsoft is up to these days. MSFT, that's not it. Okay. Microsoft is up to 237.71, and I know over the last month it has some serious dips in there. So right here on March 4th, it was down to 224. So you could have gotten this stock back on, what day is that? March 4th. You could have gotten this stock for $224, and it's now back up to 237, and you would have made some money there. So that's why you shouldn't be afraid when it hits the dips. If you have the money to invest more, that's when you should buy more, because it's going to rise back to the price that it was when you saw it, when it was doing its thing. So if you ever see dips in the market and there's something that you want, that is the perfect time to buy it. If you see if you're watching the financial news and stuff is starting to drop consistently, and they're saying it's a bear day versus a bull day or whatever, then you want to get out there and make sure that, okay, if I got an extra $1 or $2, I'm going to buy me something. I don't care if it's just all in one particular thing. Your portfolio may have 10 stocks in it, but it's like, oh, this is the one I want because I know when it comes back, I'm going to make a whole lot of money. All right? Just like with the stimulus that's coming out. A lot of people going to run out and do something crazy. Me, I plan to invest mine. Okay? It's extra money, so why not invest it? So y'all hear me? Invest your money. I don't care if you don't take, but if you get, $1,400? Invest the $400 and spend $1,000. I don't care, but put something away, please. All right? I think that was it. I just wanted to see what they were doing. Microsoft, I don't know if you guys see this. Microsoft's last dividend payment was on February 17th. So when you're looking at these can tell you, this kind of stuff can tell you what type of, this is a quarterly, they pay out dividends quarterly. Bond funds tend to pay them out monthly. So that's why I always keep bond funds in my portfolio, because I want monthly income. It kind of averages out to the same, but okay, let me put it to you this way. A bond fund, when I get my dividends are automatically reinvested. So that's reinvested every month. And even with the fluctuation, say like if it goes from 20 to 22, when it reinvests that month, it's going to invest at 22. But with quarterly investments, or quarterly dividend payments, it's like if it's at 20 here, and 3 months later it's going to be at 30, now it's reinvesting at 30. Even though you're getting a larger dividend, is investing at a higher price. But so that's why I prefer to do it with bonds. Bonds will hit it every month, whereas this is only hitting it every quarter. And if the stock market is any indication, 3 months is going to be a whole lot higher than it was a month ago or 2 months ago. Make sense? So like I said, all of that stuff plays into the diversification of your account.
Cost averaging?
Yes, cost averaging. And if you know anything about averaging, that's all it is. If you buy something today for $10 and you buy it tomorrow for $20, the average cost is $15. It's just averaging. So you want to keep that average. You want to try and work that average, because with the way the stock market is now, a lot of people will tell you, okay, they'll tell you invest, and they'll give you that whole 8% scenario. How many times you heard that? They still talking about you can expect an 8% return if you invest wisely. That has been the 8% they have been selling since I was a kid. Stocks have done such a thing that my own portfolio on Stash is up 20-something%. That is, and like I said, if you take when they tell people to save, you should take and save that same amount of money, and you get, I told Morgan, I said, we have, like $4,600 in a savings account. We made $1. That's it. It's not worth it. I mean, yes, you need your emergency fund, and you should stash some money away for emergencies and all of that kind of stuff, but please invest. And like I say, just take the basics. Start with the basics. Don't try to do anything crazy. Don't try and do futures or options. I'm still gonna learn options though. When I'm able to figure it out myself, I'm gonna share it with you guys. But start with something that you know. What is something that's been around forever? Coke, Pepsi, Tide, all of those have been around forever. Those are no longer growth stocks. Those are what are called blue chip stocks. Those are stocks that aren't going anywhere. They've been on the stock market forever and a day. And so those are considered blue chip stocks. And so the only reason you invest in those is because you know you're going to get a consistent dividend, and you know they're not going to crash. It would take a whole lot for those type of stocks to go anywhere. Okay? Even though Microsoft is doing well, Microsoft is still, it's not, I don't think it's blue chip. I could be wrong, but I don't think it's been around long enough to be considered blue chip. Because, like I say, we're talking about companies that have been on the stock market dang near since inception. Those are blue chip stocks. That's what they're called. They're called blue chip stocks because they have that longevity behind them. And that's why when you look at a blue chip versus an IPO, that's why there's that fear over here. This company may have been around for 5 years, but now you're asking me to put equity in them. And I'm going to tell you, go ahead. Hold on, AJ got a question.
I looked up Vanguard Mega Cap, blue chip, whatever, and it's got Apple, Microsoft, Amazon.
So they are
Facebook.
on there now. Okay, all right. So Apple and Apple and Microsoft are blue chip stocks. AJ, you made me lose my train of thought. What did I? But I think we were talking about versus IPOs. Okay, we had when we lived in California, we used to go to this theater called Gold Class. We went there all the time. It was a bougie movie. The movie tickets were $29, but you got a blanket and a reclining chair and all that stuff. Tuxedo popcorn, duck tacos. It was real bougie, real bougie. And so we loved this theater. So when they decided to do an IPO, we wanted to jump on it because we just knew they were going to be around forever. We put $1,000 in, and we bought. They were, I think the IPO was like $25 a share, so we bought $1,000 worth. It's worth nothing now, because even though they are still around, because the Gold Class is still around, and they have been around for years before we decided to invest, they could not make a go of it as far as equity is concerned, so they filed bankruptcy. We lost money, but they're still in business. That's why you have to be careful with IPOs. even though they've been around forever. It's just like DoorDash. DoorDash did an IPO, but DoorDash is losing millions of dollars. And I know some other stuff too. But DoorDash is losing millions of dollars. So is it wise to invest in them? Let me see what they look like on here. Maybe I know the last time I looked, they were kind of sucky. All right, let's look at their overall picture. Well, hell, sorry, Lord. But just looking at the day, they lost $7 a share. So, but their after-hour trading only went up like 33 cents. Let's look at 6 months and see what this is doing.
While you're looking at it, I got a good question, Coach.
Go ahead.
You just said something.
Uh-huh.
Like with most companies, because I know it's like you said, when companies file bankruptcy, they can still get reorganized. Like
Yes.
you say, like the company that y'all invest in, that movie
Mm-hmm.
company. Is there any way that I can, because when a company filed bankruptcy, that's public.
Chapter 11.
So, you know,
Yeah, reorganizing that.
Yeah, just like I'm gonna just say like Aaron Davis and Sears, you know, years ago they did. So that's public record, isn't it?
Yes.
Once they start doing all that.
Mm-hmm.
So, okay, so no, I'm just saying when I'm investing, I can, if I really want to invest real good, I should start looking at court documents.
Not necessarily, because even some companies that have filed bankruptcy haven't lost it didn't necessarily affect their stock price to the point of being worthless. Like I said, that was just a really bad investment for us. And that's why I say don't invest more than you can afford to lose. I ain't saying I could afford to lose $1,000, but it is what it is. It's just gone now. And then, like I said, when you get your prospectus in the mail, it is a lengthy, oh my gosh, it is so daggone long, it's ridiculous. They're usually about this thick depending on the company. They're also printed on what seems like thin tissue paper, and it's fine print. It is so tiny and small. I'm gonna see if I have one on here. But it's so tiny and small that I promise you, it'll make you crazy trying to read it.
8-point font.
I don't even think it's that big. Oh my goodness. Is this mine or is this Neil's email? I think it has Laker Nation on this Neil's email. Let me see if I think somebody sent me a prospectus recently. Yeah, let's see. Oh, here's something I wanted to share with you guys. Where'd it go? Did I delete it? I think I deleted it already. The Bumble. Here's the prospectus. So y'all can see this tiny print. You need 2 magnifying glasses to read the stuff on here. See? So this right here, you see this? Well, you can't see it. This document is 264 pages long. You can't see it on there. Hold on. See it up there in the corner? Yeah, way up there in the corner. 264 pages. And all of this is telling you about Bumble. And it just goes on and on and on. And these are the documents that you get when you invest in a company. And I'm not saying read this whole thing, but start getting familiar with it. Because this is where, like, people ignore this. Like, down here, under here, there's a footnote. Total company monthly active users as of, and that's down here, September 30th was 42.1 million, reflecting the contribution of other apps which are operated by the company. So Bumble is an app? Okay, I didn't know. I just got it because you told me it was there. Yeah, it's free stock.
Tomorrow too, I think they're doing every Wednesday.
Okay.
Dash party.
Okay, so like I said, this is telling you how many users are out there, and when they have footnotes, it's probably more important to read the footnotes than it is to read all of this other stuff. And they will give you years of financials. See, like this crazy chart. What is this? Let's see. Yeah, Yeah, and so this is from, that's actually 1940. That's 1940. So they give you all of this information, and because it's so extensive, people don't read them. They don't read them at all. And you get them in the mail, like I got this one via email, but normally you get them in the mail, and they just give you everything. They tell you, like, okay, our sponsor, who they're sponsored by. They're saying this is an emerging growth company, and I'll tell you about that. We'll go back to a definition and look at that. But all of this is 264 pages worth of financial information. Like,
And I think they think most people don't read all of it.
yep, they don't expect you to read it. They give you all the financials. See, and this is what I was talking about. Shares of Class A common stock. And there's preferred stock as well. Preferred stock, usually we can't afford it. At least I know I can't. But it gives you all of this information that you can digest and just pick apart and understand. And believe it or not, even though this is 264 pages long, this is not what stock analysts use. They don't care. They don't read this. They don't even look at it. But it's here for you. When you start buying stock, every stock that you own will give you a prospectus that looks like this. Like they're showing you revenue here. And this is from January, this is for all of last year. Let's see, in the preceding years, how many zeros are we missing? I'm pretty sure we're missing like 3 zeros.
Counts in thousands.
Yeah.
So then every stock company is gonna give you a loan.
Is going to give you a prospectus. Once you own a stock, you get all of this information. So see, and this is like stuff that you can see on here. This is also from last year. Lost earnings before taxes, they lost 105 million. They added back the interest expense. They added back depreciation, stock-based compensation, litigation costs. So somebody paid for lawyers somewhere. Foreign exchange loss, and that means that based on foreign exchange, somebody somewhere in another country, they put that back in here. The fair value of interest, transaction costs, and you pronounce this, even though this is is it acronym? How do they pronounce it? EBIT. I can't even pronounce it anymore. But I forget what it's in. Earnings before interest, taxes, depreciation, and something. I forget what the A is, but it's earnings before interest, taxes, depreciation, and whatever. So all of this is here for you. This is information that belongs to you now. You're entitled to this information. So don't just throw it away. Try to, like I said, try to start digesting it a little bit at a time. Don't make yourself crazy, because it will make you crazy. Because like I said, I think this is in 6-point font.
It's only the 25th page.
Yes, this is only the 25th page. No, this is 34.
Oh, there you go.
But look at all of this right here. So it tells you about product development expenses. I just get to the bottom line. Let's see. Wow. Owner's equity is 2.04 million or billion or whatever they do. I'm missing zeros. Like I said, I always forget how many. Some have 2 zeros behind it, some have 3. But you want to know if they're making money. So you might want to peruse through this. Okay, this is showing that they had a net loss. Yeah. Anytime you see parentheses around around a number, that is a negative number. Instead of putting a negative sign in front of it, that means it's negative. If it's not red, then the parentheses mean that, you know what, that's that. But I wanted to show you guys this. This is what a prospectus looks like. It's just constant information. There are financials, like you saw going back to 1940, looking at charts from that. And trying to understand this will make you crazy, so don't expect to. But I just want you to see how extensive this is. Like I said, okay, we're just up to page 56. And you will get, I guess they want to stop doing these by mail because, like I said, that's killing a whole lot of trees. But there are certain things that you can go in here and you can pick out that might be of interest to you. And there's still more. So that's a prospectus, a long, long prospectus, which comes with every stock that you buy. Okie doke. There was...
Another reason for ETFs.
Yes, another reason for ETFs. Yes. There was one other. Like I said, you don't have to worry about preferred stock. Like I said, if you're that kind of baller, then you're probably not even sitting here listening to me. There was one other definition I wanted to share with you guys, and I can't remember what it was. And this is why I said I need to do slides, so I have them already together for you guys.
You got 2 weeks now.
What, 2 weeks? Oh, yeah, I got 2 weeks to get it done now. Yes, I do. Whatever. Do you guys have any questions, any other questions?
Sorry for the night. My mind
Oh, like I said, you lost your wallet. That is totally understandable. I don't expect you to. Yeah, okay. Let me tell you guys, I'm an Investopedia, okay? I'm on the Why is Jay-Z on here?
That's what I was saying earlier.
Wow. Jay-Z is a definition. Wow. Why is he? Okay. So they're talking about the 10 richest men. Elon Musk, 197 billion. Jeff Bezos, Amazon, 182 billion. Bill Gates, 132 billion. Bernard Arnault, 109 billion. And Mark Zuckerberg, 95.6 billion. Why y'all holding all the money? Folks out here struggling, and y'all holding on to all the money.
And they showing you too, aren't they? Showing up.
And see, and this is what I was telling you. Okay, so Jeff Bezos, Jeff Bezos, he only owns 11% of Amazon stock. So, but it's still worth $165 billion.
So they was founded in 1994.
Yes, that's how new that company is, and that's how much it blew up. And mind you, when Amazon started, they were losing money year over year consistently.
Yeah, you can see.
Yes.
And then finally.
Yes. So,
Walmart was trying to get bigger than Amazon now. Y'all
I don't think they'll make it.
You don't think they will?
Nah. Let's see.
I saw on the news that Amazon's starting to make brick and mortar, like grocery store type.
Well, they were buying grocery stores. So, like I said, if you can afford Amazon, because I think Amazon stocks trades for a couple of thousand now a share. So, and here's another one. And this is just showing you how much people own of their companies. Bill Gates owns 1.3%, which is 22 billion. So his other assets are all of these.
But now Bill Gates and Paul Allen, they invented that and they sold off a lot. You remember Paul Allen?
Mm-hmm. But that's just like Oprah just sold off part of OWN, I think, and she sold it for cheap. She only sold it for $35 million. But I guess that's all she wanted.
Yeah, because as they get bigger and bigger, they sell off a lot of these.
Yeah. Okay, Bernard Arnault, he owns most of his shares. He owns 97.5%, 92.8 billion. He's not giving up nothing. Okay? So, like I said, we are common folk. We own common stock. That is not a bad thing. If you're trying to get to this level, trust me, you're going to have to be an entrepreneur and a whole lot of other things. It's not just about investing. Yes. AJ.
So with taking into account cost averaging and everything, it's probably better to do like the $10 a week or whatever instead of the $40 a month.
Yeah, and that's, to me, that is why I invest every week instead of, because I can take it, based on how we invest, I do $75 a week. which is what, $153, $300 a month. So I could just take that chunk and buy in chunks. But like I said, because the prices fluctuate from day to day, I invest every Monday. Every Monday. I don't care if it's, and mind you, that $75 is split over like 5 to 7 stocks. It just depends. But every Monday I'm buying something. And see, I'm a different kind of investor. My husband, he's one of those, he's like, you know what, I'm gonna buy some Pfizer this week. He didn't own Pfizer last week, but he's buying some this week. He decides, you know what, I'm gonna sell off so-and-so and I'm gonna buy this over here. And he does that. That's how he invests. And we still kind of have the same, mine's is a little higher, I'm kind of beating him. But me, I invest in the same things every week consistently. I invest in Microsoft, I invest in my Schwab account. I invest in KWY. I can't remember. I think it's KWY. I recently started investing in PAN. PAN is about to be bought by Merck Pharmaceuticals, so I'm looking forward to that jumping up. Oh, this is the other thing I want to tell you. Tender offer. We may never have to be bothered with it, but tender offer, just so you know what it is. When I bought PAN, because I knew PAN was going to be bought by Merck, they sent what's called a tender offer. What that means is that when companies want to take over other companies, they will offer everyone who owns stock, preferred stock. I just own common stock, but everyone that owns preferred stock, they'll offer to buy up their shares because they want controlling interest. So if I own that stock at $100 a share, they might offer to buy it from me for like $115. So people can make a lot of money by selling it off that way, but mine is just going to roll over probably into Merck because it's a preferred stock. But then because it is part of Merck, it will do a whole lot better. And that ticker symbol is PAND, just in case anybody wanted to know. So that is why I bought it, because I knew they were going to be bought up by Merck, and Merck is very big. So those are things you can look at. Another one, what's the other one that I got? I can't remember. But that's probably the only change I made to my portfolio recently. Like I said, I'm very consistent in how I invest. I'm that same stuff, same bet channel, same bet time, all of that kind of stuff. Because I want the things that I have to grow. I want to own more shares of that than owning multiple shares of everything all over the place. Like I said, my husband's stock portfolio, it makes me crazy. So, is there anything else we need to cover? Like I said, I wanted to go back over the basics because someone asked, and like Michael told me, I got 2 weeks to get some slides together for you guys so that this can go a little more smoothly. If there's anything that you want to know, please send an email to the church or text the pastor or first lady, and they will let me know. Like I said, huh? Oh, and AJ said you can leave comments on the videos because he can see your comments, but he's been sitting up here with me, so he's gonna let me know. Huh?
No comments today.
Okay, no comments today. Woohoo! But like I said, if you guys have any questions, if there's something I don't know, I don't mind looking it up for you. Just let me know what it is. Stay invested. Teach your kids about investing. Teach your kids financial literacy. Teach them to buy a label instead of wear a label. Is so much better for them. There is nothing wrong with being suited and booted. I have no problem with it. But have some money to put in your pocket. So, like I said, if you're going to buy a label, buy one that you can invest in and then wear it after that. How about that? All right? Since there is nothing else, we're going to roll on up out of here. Dear Lord, we thank you for this opportunity. I hope something I said makes sense to somebody, somewhere, somehow, some way. I appreciate all that you're teaching me. I thank you for the wisdom and the knowledge to be able to share what I know. I know I don't know much, but Lord, whatever I know, let it bring somebody else closer to what they need to know. And let them move on past me. I don't care. Let them teach me something. So, Lord, we appreciate you and we love you and we give you all the praise, honor, and glory. We do this so we can pay our tithes as well. In Jesus' name, amen.